The tariffs are kicking in, but they're not making Americans rich. Instead, the wealth is pouring into China. That's right, Chinese stocks are reaping the gains of Trump's tariffs. Let me show you a list. Alibaba is up by almost 70% since January this year, 70%. Then we have Tencent, the maker of the WeChat app. A few years back, Tencent was the target of Chinese regulators. It faced a crackdown, but now Tencent shares are surging. Last month, Tencent co-founder Pony Ma briefly became China's richest man.
Imagine a place where search engines rival Google, electric cars charge quicker than you can brew coffee, and your smartphone brand suddenly starts making luxury sedans. Welcome to China in 2025, a dynamic, occasionally turbulent playground where various tech giants are rewriting the rules of innovation, technology, and global business. Between 2013 and 2023, the latest year for which complete international data is available, the U.S. gross domestic product, GDP, grew about 64%. Over that same decade, China's GDP grew by more than 112%, nearly twice as fast. With this in mind, it's no wonder that Chinese stocks are of interest to U.S. investors. Sure, investing here is not for the faint-hearted, with geopolitical tensions and market shakeups lurking around every corner. But for those daring enough, massive rewards await. Curious about the top Chinese stocks primed for explosive growth and how to get your share of this financial whirlwind? Let's dive in. Baidu, often referred to as the Google of China, is a company that has reinvented itself over the years. Traditionally known for its dominant search engine, Baidu is now making a significant pivot toward artificial intelligence. In early 2025, the company launched a cutting-edge AI model designed to compete head-on with rivals like DeepSeek. This strategic move led to an immediate 12% surge in its stock price, with its market capitalization rising from roughly $50 billion to nearly $55 billion within a few short weeks. The success of Baidu's new AI model is a clear sign that the company is positioning itself as a leader in the next wave of digital transformation. Analysts note that Baidu is reinvesting a considerable portion of its earnings into AI research and development. Government support for AI in China has grown by over 30% in the past 2 years, creating a favorable environment for companies like Baidu. As AI continues to permeate various industries, from advertising to autonomous vehicles, Baidu's aggressive innovation strategy makes it one of the most promising stocks to watch in 2025. BYD. In the race for electric vehicles, BYD has emerged as a standout leader in China. Recently, BYD unveiled a breakthrough charging technology that allows an electric vehicle to travel up to 400 kilometers, 248 miles, on just a 5-minute charge, a feat that is nothing short of revolutionary. On the day of the announcement, BYD's stock soared by over 20%, reaching record highs that underscore the market's enthusiasm for its technological advances. This innovative charging technology addresses one of the most significant hurdles in the EV market: charging time. Traditional EV charging can take anywhere from 30 minutes to several hours, but BYD's new system could dramatically cut that time, making EVs more practical and attractive to a broader range of consumers. Industry experts forecast that this breakthrough could boost BYD's market share by an additional 15% over the next year. Moreover, revenue forecasts for BYD's EV division have been revised upward by nearly 25% year over year, reflecting strong investor confidence. As global demand for sustainable transportation surges, BYD is well positioned to capitalize on this trend, making it a top pick for 2025. Xiaomi is a brand that many associate with high-quality, affordable smartphones. But in 2025, the company is proving that it is much more than a one-trick pony. In the fourth quarter of 2024, Xiaomi reported a staggering 90% surge in net profit, achieving record revenue of 109.01 billion yuan, approximately $16.5 billion. These impressive financial results highlight Xiaomi's operational efficiency and its ability to capture market share. Beyond its success in the smartphone arena, Xiaomi is boldly diversifying its business. The company has entered the electric vehicle market with its luxury SU7 Ultra sedan. Early data indicates that pre-orders for the SU7 Ultra have increased by about 30% compared to previous EV launches by competitors, signaling strong consumer interest. This strategic move not only helps Xiaomi spread its risk, but also positions it in a high-growth market. As competition in the smartphone industry intensifies, Xiaomi's expansion into new sectors such as EVs is a smart way to secure long-term growth and reinforce its status as a diversified tech powerhouse. Tencent is one of China's most dominant tech giants and a household name across the globe. Best known for its immensely popular social media platform WeChat and its robust gaming division, Tencent continues to excel by expanding its reach into fintech, cloud computing, and AI. In 2025, the company reported an 8% increase in revenue year over year, with its gaming segment alone experiencing a 15% boost in user engagement. This growth is fueled by the launch of new gaming titles and enhanced mobile experiences, which have drawn in millions of users. Tencent's diversified business model is one of its greatest strengths. With revenue streams spanning social media, digital content, gaming, and fintech, Tencent has built a resilient ecosystem that can weather market volatility. Its cloud computing division, which has grown by about 20% compared to the previous year, underscores its commitment to embracing digital transformation. Holding a market capitalization of around $600 billion, Tencent remains a stable, long-term investment. For those seeking a balanced blend of growth and stability, Tencent stands out as a reliable choice in the ever-changing tech landscape. JD.com. JD.com has revolutionized online shopping in China through its efficient logistics network and cutting-edge use of technology. Over the past year, JD.com has invested heavily in artificial intelligence and robotics to streamline its operations and improve customer service. These investments have resulted in an 18% year-over-year increase in revenue, with the company's market share growing by about 10% compared to last year. JD.com's technological enhancements have not only reduced order processing times by nearly 15%, but have also enabled the company to expand its reach into lower-tier cities and rural areas. This expansion has opened up new markets and contributed significantly to its overall growth. As the digital transformation of retail accelerates, JD.com's ability to integrate advanced technology into its supply chain positions it as a key player in redefining e-commerce. Investors are excited by JD.com's tech-driven strategy, which promises to deliver consistent growth as online shopping continues to evolve. How to buy China stocks. If you want to buy US-listed Chinese stocks like the ones above, you'll need a brokerage account if you don't already have one. Some Chinese stocks that aren't listed on major exchanges are available OTC, but it's worth checking the volume on an OTC stock before buying to be aware of any potential liquidity problems that may make it difficult to buy or sell at a good price. OTC stocks, even large ones like BYD, may only change price a few times per day due to a lack of buyers and sellers. That can cause market orders to go through at suboptimal prices, although limit orders can control this risk. There are also a few brokers that offer U.S. investors direct access to foreign stock exchanges, including the Hong Kong Stock Exchange. This is rare, however, and those brokers may have special requirements for investors who want to trade directly on foreign exchanges. Of the brokers, only Interactive Brokers, Fidelity, Charles Schwab, and TradeStation offer foreign stock market access. Another possibility is to invest in Chinese exchange-traded funds, ETFs, which can offer U.S. investors exposure to dozens of Chinese stocks with a single investment. China ETFs may be simpler to invest in than individual Chinese stocks, but it's still important to research them before buying, just as you would research stocks. And keep in mind that Chinese ETFs may be subject to the same geopolitical and economic risks as individual Chinese stocks. Pros and cons of buying Chinese stocks. Like any other investment, Chinese stocks come with a unique set of pros and cons to consider before buying. Here are the pros of investing in China stocks. Rapid growth. China is an emerging market with a faster-growing economy than ours, and its government is notorious for finding ways to give Chinese companies a leg up over foreign competitors. Many Chinese electric vehicle EV stocks, such as BYD, have claimed large portions of global market share in recent years. in part thanks to Chinese government restrictions on foreign firms such as Tesla, TSLA. Diversification. Chinese stocks provide investment diversification to Americans by giving us exposure to a major non-US economy with a different cycle of boom and bust than ours. Stock market crashes in the US might not affect China and vice versa. Cons of investing in China stocks. China is currently experiencing a financial crisis, reminiscent of the US housing market crash of the late 2000s. In recent years, several major Chinese real estate developers and lenders, such as Evergrande and Country Garden, have faced insolvency amid a rising tide of mortgage defaults. The full extent of the damage to the Chinese economy remains to be seen. Geopolitical risks. The US and Chinese governments don't always get along, and tensions between the two countries can cause problems for investors. A 2020 US law threatened to delist dozens of Chinese companies from US exchanges unless they used an auditing firm that complies with US accounting laws. Its passage tanked the prices of many Chinese tech stocks. Most of the companies in question ended up complying, but there's always the risk of something similar happening again. Government policies that aggressively support high-tech innovation and domestic consumption. The nation has emerged as a powerhouse in fields like artificial intelligence, AI, electric vehicles, EVs, and digital services. One of the defining moments in recent years was during the Trump administration, when tariffs of up to 25% were imposed on many Chinese goods. These tariffs, while disruptive initially, forced Chinese companies to innovate rapidly and reduce their reliance on foreign technology. As a result, many sectors have experienced growth rates exceeding 20% annually. Global capital inflows are also on the rise, with some indices recording a 30% year-over-year uptick compared to last year. In short, if you want to ride the wave of technological and economic transformation, understanding China's top stocks is essential. Final thoughts. Investing in China is not just about chasing short-term gains. It's about being part of a transformative journey that's reshaping entire industries. Companies like Baidu, BYD, Xiaomi, Tencent, and JD.com are at the forefront of this change, each contributing to the evolution of technology, sustainability, and digital transformation on a global scale. The data and trends up to early March 2025 paint a clear picture. China's market is on an upward trajectory, driven by both government support and the relentless pursuit of innovation. Global capital inflows continue to rise, and the resilience of Chinese companies, honed by past trade disruptions, such as the aggressive tariffs during Trump's administration, sets the stage for long-term growth. Investors looking to capture this momentum would do well to consider these top stocks, which offer a unique blend of stability, high growth potential, and forward-thinking strategy.